Hi everybody, this is the investing teacher, high school science teacher, teaching others how to invest. I wanted to show my quick shirt. Science is magic that works. In this video I want to go over credit spreads and some of the basic parameters on how to manage the credit spreads. We're going to go over how to initially start your position, looking at probability to profit. We're going to look at making a buy to close order to lock in some of the profit that you might receive. And we're also going to look at stop loss orders. Credit spreads are good for lower account sizes, even large account sizes. But if you're looking at a stock for a strike price of 150, instead of putting $15,000, you can maybe make it a credit spread. Use $500, $1,000, and then you can get pretty similar returns. But you got to be careful with the risk involved. So we're going to go over all that as well. If you're interested for the rest of the month, I am still having our Patreon that you could join for free, and we're going to give you 2 different recommendations each day, private Discord, and you can ask me any questions. So let's get right to it. Okay, so you're going to look at how to manage credit spreads in terms of starting the spread at good parameters that might be pretty safe, managing the buy to close order, lock in your profits, putting in a stop loss order so you don't have your max loss, and then adding in new funds when you have a new money available. Let's get right to it. So first we're going to look at low deltas when starting out. Your delta gives the approximate probability of profit. So what you want to look for in the short position, when you're shorting a put or shorting a call, you want to have the delta, I like at least 0.1 or less, because 0.1, if you take the opposite or inverse of it, you'll get a 90% profit in this case. When you're going at higher deltas, 0.2, 0.3, there will be more gains, but it also could be a lot more risky, and they're a lot harder to manage in terms of the stop loss, or you might get your max loss, which is what we don't want to do. So I'm looking for deltas of around 0.1 or even less for ETFs. For stocks as well, you might want to go even lower than that because stocks could be more volatile in general. But just be careful when you're starting with your short strikes. You could also look at the width of the spread here. So typically if you're starting at, say, 0.1 in your short spread, the long one will be around 0.08, 0.07 if you do a 5-strike width. Okay. Next, we're going to look at how to manage the buy to close order. I typically like to do a 50% profit from the initial premium received. And the reason for this is you want to lock in your profits so that you could cycle in new trades, just like I show in a lot of my cash secured put trades that I have. So for instance, let's say you made a put or call credit spread and you received $30 in premium. You're going to buy to close that at $15 and 50% profit. Don't get too greedy waiting for the position to get 100% profit. You could see stocks and ETFs move on a whim at sometimes, so you got to be careful with that. And 50% profit with the positions that I look for, getting around 4 or 5% a month in the initial spread. If you could buy the close at a 50% profit, you're still at 2, 3%. And sometimes you get that in a couple of weeks. So don't be too greedy if you're profit taking. Okay. Next, we're going to look at putting in the stop loss order. I typically like to look at a stop loss at 3 times the premium received. Now, in this case, you won't get the max loss, which is the width of the spreads. You might get stock out early, meaning if the stock starts to go a little bit against you, may not be in the money in your short spread, but you might be able to have to get out of that position before it gets close to that max loss. 3 times premium, I think, is a good buffer. There's a lot of studies from Tasty Trade showing around 2.5 times, 3 times premium. For a stop loss would be ideal. So for example, in that last case, if you received $30 in premium from your credit spread, you're going to do a stop loss order at 90 or 0.9. In this case, if the position goes more negative, closer to your short strike, then you'll be able to hit that stop loss. You'd lose $60 in this particular transaction. However, you won't lose the max loss, which is the width of your spreads. So if you did a 60/55 put credit spread, you can lose $500 minus that premium. So 470 is a large max loss. So I think a good 3 times premium is a good initial buffer, especially if you're beginning this out, to have that stop loss order. And finally, you want to add in new funds. Keep your money working for you. You don't want to just be leaving money on the sidelines. Look for different opportunities that might be able to be beneficial, that still get your similar profile from your risk return that you did in the previous one. So when your money opens up after the buy to close, or if it hits your stop loss, just cycle in a new one, find another position, similar probabilities. Okay. So I guess that's just a general guidelines on beginner credit spreads. This is a helpful way to manage your trades, especially if they don't go your way. Okay, finally, let's look at one of the credit spreads that I just did on Friday on August 13th, 2021. I'll show you the reasoning why I did this credit spread, what I'm doing to buy to close early at the 50% profit, and to set that stop loss order. Okay, so this morning I did a vertical credit put spread for TNA. This is a triple levers ETF, but as you'll see, I did it relatively safely with the strike prices. TNA at the time was at 87.03. I sold a 60 put and then bought a 55 put, which makes it a credit spread because I sold a put in a closer strike than what I bought it at. The delta on the 60 put was 0.07, again looking at lower than the 0.1 delta. I did receive 0.27 credit, so $27 credit, $27 out of a $500 max loss. We're looking at a 5.4% return on a position where the short put has about a 93% probability of profit, which I like the odds on that one. And then I'm going to buy to close it at around 0.115, give or take. That's about 50% profit from the 0.27. And then we're going to do a stop loss at 3 times the premium received. And I put a stop loss at 0.75, just slightly below the 3 times premium. Okay, so hopefully this example that I showed and the parameters we're looking at will help you in looking at credit spreads. Again, they do help lower the amount of capital required. Instead of using $6,000 for TNA, you just have to use $500. But again, be very careful with those max losses because you don't want to lose $500 on a $500 position where you're only earning 27. So make sure you put your stop losses in. If you have any questions, feel free to leave a comment down below. I'll read and respond to all questions. And have a good day, guys.